welcome to the deep dive. Today we're really digging into something fascinating, that U.S. Stablecoin Bill from 2025.
Right. We've been looking at this really interesting analysis, trying to understand what's really going on beneath the surface.
Exactly, not just the headlines. And the core idea we're exploring, based on this source, is that this bill, it's not just reacting to something happening now.
Or simply about, finding new ways to sell government debt. It seems more strategic than that.
Yeah, it feels much more like they're trying to proactively control the future path of stablecoins, making sure they serve specific U.S. interests down the line.
Setting the rules of the game early on.
That's the plan for this deep dive. Let's really try and get to grips with why this particular take feels so, well, compelling.
It's definitely a perspective focused on control, not just immediate market stuff.
Okay, so let's jump into the first big point from this analysis. How the bill basically turns dollar stablecoins into a kind of fiscal arbitrage tool. That's the term they use.
Yeah, and the logic they lay out is, well, pretty straightforward when you break it down. Starts with trust.
Right. The whole world trusts the U.S. dollar, more or less. So people want stablecoins pegged to it, especially in the, wild world of crypto.
So companies pop up, issue these stablecoins, meet the demand, standard market stuff so far.
But then the U.S. law comes into play, the 2025 bill.
And this is the crucial part. It mandates that these stablecoins have to be backed by high-quality liquid assets, HQLA.
Okay, sounds sensible.
But it specifically puts U.S. Treasury debt right at the top of the list. It prioritizes treasuries.
So it's not just any safe asset. It nudges them or forces them towards U.S. debt.
Pretty much forces them. To operate legally, these stablecoin issuers have to use their funds, whether it's their capital or user deposits, to buy U.S. treasuries.
So you end up with this new group of buyers for U.S. government debt, buyers who are there because the regulation basically says they have to be.
Exactly. Almost resistance-free buyers, as the source puts it. It's leveraging that existing global trust in the dollar.
And turning it into built-in demand for U.S. treasuries.
That's what the analysis calls the fiscal extension capability of dollar hegemony, using the dollar's global power to prop up U.S. fiscal needs almost invisibly.
And what's really striking here, according to this source, is the idea that this wasn't an accident. Regulators didn't just stumble into this.
No, the suggestion is they saw this potential channel. They saw how global dollar demand could be linked to treasury purchases via regulation.
And they built the rules specifically to capture that, to ensure that if you want to issue a dollar stablecoin legally, you must feed into the treasury market.
It's presented as a very conscious, preemptive, strategic move. Control the pathway.
Okay, but here's where this analysis gets, well, really interesting. It points out a major weak spot in this whole setup.
Right. It argues the whole thing rests on what it calls a very dangerous premise.
And that premise is
that people will just keep wanting to use dollars forever.
Which, seems like a safe bet now. The dollar's king.
Sure, for now. But the source we're looking at emphasizes that nothing's guaranteed. You've got all this talk about financial fragmentation, de-dollarization efforts heating up in different parts of the world.
Things are shifting slowly, maybe, but they are.
And if confidence in the dollar starts to wobble, even a bit, or if, say, Euro stablecoins or RMB stablecoins or even some basket-backed ones really take off.
And demand for dollar stablecoins could drop.
Precisely. And if demand falls, then those issuers, they might not be willing or even able to keep buying all those U.S. treasuries the law requires.
So the mechanism breaks down if the underlying demand isn't there.
Exactly. The conclusion drawn is that this whole fiscal tool is kind of riding the wave of the dollar's current popularity. The inertia of dollar momentum, they call it.
Not based on institutional rigidity, meaning the law itself isn't strong enough to force the outcome if the market turns away from the dollar.
Its success depends entirely on the dollar staying popular, not just on the regulation being on the books.
Okay, so that begs a pretty big question then. If the bill isn't tackling some massive urgent problem right now, and its core mechanism depends on future dollar popularity, what's the real point?
Well, the argument we're exploring here is that the main goal isn't about, betting on the stablecoin market getting huge.
It's not about the scale.
Not primarily. It's about seizing the rule interpretation power, controlling the narrative, the framework.
Because stablecoins, they operate in this sort of gray zone, right? On the edges of traditional finance.
Yeah. The source notes, they haven't necessarily sparked massive world-changing innovation yet, but they definitely attract, let's say, gray funds, arbitrage money.
And some genuinely innovative fintech firms, too, trying new things.
True. But their features, super easy cross-border movement, hard to trace sometimes, the potential for bypassing banks, capital controls, money laundering risks.
That makes regulating them more than just, financial plumbing.
According to this analysis, it's seen as a sovereign currency survival problem, a fundamental challenge to a nation's control over its own money.
Wow, okay. Sovereign currency survival. That's strong language. What's the thinking there?
The idea is that if these things proliferate unchecked, they could seriously undermine a country's monetary policy, its capital controls, the basics of economic sovereignty.
So the U.S. regulatory approach, from this perspective, is about defense.
Defensive control. The thinking is, fine, if dollar-pegged stablecoins are going to exist, we must make sure they operate only on the track we lay down, within our institutional framework.
Which leads back to that really stark line in the source. Something like, I don't need you to succeed, I just need you to obey.
That's the one. Even if your stablecoin project is tiny, captures just 1% of some market somewhere, if it's pegged to the dollar, you must follow the U.S. rules, including that fiscal logic of buying treasuries.
It's all about setting the path, what the source calls path control type regulatory philosophy.
Yeah, define the boundaries, define the terms of engagement, long before you know how big the thing will actually get.
And the numbers seem to back this interpretation up, right? The scale argument.
They really do. The source points out the whole dollar stablecoin market is, around $200 billion?
Sounds like a lot.
But compare that to the U.S. national debt, $34 trillion. It's a drop in the ocean.
So even if, let's imagine, all stablecoin reserves were suddenly put into treasuries.
Which isn't even the rule, but just for argument's sake.
Right. Even then, the extra buying demand is maybe 0.6% of the total U.S. debt market. It's functionally zero in terms of actually helping pay down the debt.
Yeah, from a purely fiscal relief perspective, this analysis says the bill achieves almost nothing. It doesn't move the needle on debt volume.
The strategic value? That's where it shines, according to this view.
Absolutely. The symbolic significance and institutional exclusivity, as they put it, that's seen as very high.
It sets the precedent. It basically declares, if you want to create a digital derivative of the U.S. dollar, the only legitimate way is through our regulated channels.
It ties any future innovation in this space, if it involves the dollar, directly to compliance with the U.S. financial system and its rules.
And it sends that message globally. Want to play with dollars on the blockchain? Fine. Buy our debt first. Follow our rules.
Which really hammers home the source's main point. This isn't about betting on crypto taking over the world.
No. It's about locking in the rule interpretation power, now just in case. Ensuring the U.S. dictates the terms for any future digital dollar ecosystem.
It's a regulatory hedge in a way.
And this isn't just a U.S. phenomenon, right?
Yeah.
The source mentions other examples.
Yeah, it points to Hong Kong. Their 2024 guidelines encouraging the development of Hong Kong dollar stablecoins, HKD stablecoins.
And the source kind of asks, who actually needs an HKD stablecoin right now?
Exactly. The real-world demand is probably tiny, almost non-existent for most use cases.
So why the policy then?
Again, symbolism and future positioning. It's about Hong Kong signaling, hey, we're players in financial innovation. We have regulatory capacity here.
Okay, showing capability.
And, perhaps more strategically, building an institutional bridge, a framework that could potentially be used for, say, RMB stablecoins in the future. That's the bigger picture, maybe.
And it's also about Hong Kong asserting its own space, its voice, in how digital assets are governed, even within its unique political context.
It's the exact same logic we see described for the U.S. bill. Institutional stance precedes market demand.
You plant your flag, set up your rules, even before there's a huge crowd demanding entry.
Right. This whole idea of symbolic governance, as the source terms it, it's apparently a known concept in political economy.
Less about fixing today's specific problem, more about shaping the future battlefield.
Precisely. Controlling the direction of travel for an emerging field, asserting sovereignty over it.
Okay, so let's try and bring this all together. To wrap up this deep dive, the source we've been exploring really paints the U.S. stablecoin law not as some kind of market-driven initiative.
No, not at all. It's framed fundamentally as a structural control play, a sovereign currency defense mechanism.
Built on that bedrock principle. If you're using our currency, the U.S. dollar, then you play by our rules, our fiscal rules, our regulations.
That power, that privilege of issuing the world's reserve currency, it comes with strings attached. And this law is just extending those strings into the digital realm.
And that core logic, The real takeaway from this perspective is
Well,
captured in that one line we keep coming back to.
this is not about being optimistic about the future, but about controlling the future.
It's not about making the dollar stronger, necessarily, but about making the dollar's strength more useful for U.S. interests.
It really shifts the focus, doesn't it? Away from just market size and potential profits towards strategic control, sovereignty, and integrating national interests into new tech.
It absolutely does. And it leaves you thinking, this whole philosophy of path control, setting the rules for a future that might look very different. What does that mean for other new technologies?
Right. Things that might challenge existing power structures or bypass old systems.
Could we see similar moves in AI regulation or biotech or other fields? This sort of proactive, control-oriented approach shaping things before they fully bloom?
How might this quietly reshape things globally in ways we don't even see clearly yet?
Definitely something to mull over.